Show. Jim Bianco, welcome, my special guest. Like we have nothing to talk about, right? All right, so let's start out. Fed meeting next week. Boy, good data today, which should give us some really nice revisions to Q2 GDP, right?
Correct, yeah. The control group of retail sales was revised up. That goes in the GDP.
And it was a good one this month.
Yes, so that should help not only boost the first quarter in revisions, but also help the second quarter.
It's very similar to the way we started out in the first quarter, looking weak. And, you know, as you started to get into it, you gained traction to the upside. Okay, another topic, not so happy maybe. All depends which side of the market. We saw the inflation expectations in the University of Michigan really take a plunge.
Not only take a plunge, but the 5-year, 10-year forward is at 2.2, the lowest ever in the 25-year history of the survey. Consumers expect less inflation now than they did at the depths of the recession in 2008, 2009. There is no inflation expected anywhere in this economy.
All right, so it brings us to the age-old question. Is the market going to get an easing? And you believe yes. So we're not going to debate that because I think they should be stingy. What I would like to debate is something you told me regarding some of the meetings that were in Chicago when they had the big Fed research get together.
Yeah, last week they had the big research meeting, and one of the things that they argued is that what the Fed should do with policy is come early and hard, and then cut or ease a lot, and then pull out real fast.
Okay, now hold on.
Don't drag yourself in.
I was in New York, and Steve and I had this debate. I thought that the Fed should be more like the markets. Instead of being on a road in one direction, then boom, a road in another direction, like markets, ebb and flows, and they should take more of that methodology.
Absolutely, because what the results was of their studies was that is the most effective. If the economy is slowing and you want to get it boosted up, you come hard, you get it boosted up, and then, but this is just as important, get out quickly.
Take it back so you don't have the bubble mentality that usually goes along with once they start easing, they usually overdo it.
Right, or when they start tightening, they overdo it too. The ideal way that they should be in a tightening cycle or an easing cycle should be 3 cuts, 1 hike, 2 cuts, 1 hike, 3 cuts, then you go 1 hike, 2 hikes, 3 hikes. I guess now we're in a hiking cycle. If they would take that kind of market mentality and be a lot more aggressive in the beginning, I think they would really get rid of this idea that they're fostering market bubbles.
And even more important than that, in a way, is this notion that it gets off this game plan, that everything is cycled in such a way that the public says, well, okay, if we're in a measured tightening or measured easing cycle, we will behave a certain way, and that's usually the underpinnings of the bubble. Your final thoughts?
Absolutely. 2004 to 2006, 17 rate hikes, 2 years, 17 meetings was so telegraphed. You still had a bubble mentality, even though they were raising rates, because everybody knew to the day, months out, what exactly their financing costs were going to be. Introduce a little uncertainty, will go a long way towards getting rid of bubbles.
I can't wait to see if any of that comes to fruition. Sometimes it's like prototypes at an auto show. You see a cool car, but it never makes it to production.
Exactly.
Jim Bianco, thank you.